how to pick out strikes, how to trade trends, kind of things that should be really, really basic and simple. So yeah, I'm going live right now on the stream.
I'll talk to you through the DM.
For those listening on the stream, I'm gonna basically mute myself here on the public voice chat here, and you can hear me through the Twitch TV stream. Should be up right now. All right, let's open this up. Some basic charts. Just give me a moment here. Still getting things kind of sort of set up here. Okay. So welcome to the webinar/workshop. The purpose of this webinar, let me just move all this around here. The purpose of this webinar is to get people to understand their place in the market, get people to basically understand what they're supposed to be doing and what their purpose is, how they're supposed to make money, right? So one of the things that people seem to have trouble with is understanding how to trade general channels and trends. Um, I know that there are a lot of people who like to call, the way they trade different things, but we're going to be just touching up on trading channels, trends, how to pick out the correct strikes based on those channels and trends, and what does it mean, right? What is your place in the market? What does it mean? And how are you actually supposed to profit on these trades? So what we're going to be talking about, one moment, have a bit of a thing here. Yeah, anyway. So so the idea here is we're going to be talking about some trends and some of the things that we're going to be trading and what we're looking forward to in the future. So what I have here is essentially the Apple chart, right? And the Apple chart shows us just some minor trends here that have been forming, and we have the support and resistances. Um, and these are support and resistances of on the dailies that show us basically you can draw Darvas boxes with these from the support and resistances, and the script for the support and resistances I will provide right now on the public chat. Give me 1 second. And you can just plug that in to your TOS. And with that, you should be able to see the support and resistances that VS used to get his gains this past week, and the gains that we saw this past week with Netflix puts, Apple puts, and so on. Also, I want to make some statements about the general market right now. As you guys know, the market is in a crazy period of correction. Even passive investment strategies are pretty much down. If you got in the beginning of the market, like you were probably taught in college, you are now down about 10 to 12% of your portfolio because, well, this market doesn't like anyone. Nothing you can really do about that. That is just how the markets are going to be at the time while we have this posturing, art of the deal going on, and all this craziness going on. So what we have here in front of us, change topic, is the Apple chart. And what you see here is the uh, trend line that I drew here. Okay, you see this, me moving this around. So this is a trend line that I kind of drew here, a channel I drew here using the channel tool that is given to me by the fine folks at Thinkorswim in their software, right? And basically what I'm doing with this is I'm moving this channel to the top and the bottoms of the perceived channel that I see. Okay, so this channel. Now let's draw. Let's say, in fact, let's draw a new one, right? So let's draw a new channel here, just so you can see what I've been drawing. Okay, so I brought this up in the channel a few days ago that currently Apple is trading in this, this basically 210 to 230 range, 220 range, really, right? And the idea is that this is the kind of the same thing that Apple has done multiple times before it's dropped. So here is me pulling out of this chart here on Apple, and you can kind of see the general trend, of course, is still going up, right? Every time we're above this linear regression channel uh, slope right here, we tend to fall back down to it, right? So the idea is that that's great and all, but how do you actually decide when and where it's actually going to fall back down, and where is the actual channel and where are the gaps made? Because, for instance, we see here in this particular area of the price action that there was a ton of buying, no selling, right? So there was this gap that was made here at 197, okay? 196.55 to 195.72 has a gap, right? That was never filled. And then the concept here is that eventually the market fills all gaps, right? Um, so the idea is that we have a couple of channels that we can draw here. I posted this picture before, but I'm going to be using Thinkorswim here as part of the workshop, because that is the tools that we're using here. So I'm going to use the channel tool here, and we're going to use this channel tool simply to find the channel to go through, right? So here is the channel here. We're just going to go ahead and say this is the channel, right? And then the bottom of the channel is, we're going to say this point right here, where we come down and test the Darvas box bottom, and we come back up. And as you'll see, we've already tested the bottom of this channel and bounced off it 1, 2, 3 times. Okay? So right now the general trend of Apple is to stay within this channel, stay within this 216 to 230 range, right? And if you were to draw just, some wave drawings, you want to say that, let me see here. Can I actually draw a wave drawing? Yeah. Not really, but let's say you wanted to draw some wave drawings, right? So we'll draw a trend line here. We draw this trend line going all the way down here, bouncing off, right? Then we draw another trend line going up, bouncing off. So we can see these trends, right? Going down and through, and you can essentially trade them up, down, up, down. So here we have this really long trend up that broke through the top of our channel, right? But we couldn't make a new channel when we broke through the top of the channel, right? So since we didn't break the channel, since we didn't make a new channel, we were forced to come down and test the bottom of the channel after the break of the channel, right? And then we have the bounce, okay? Now, the next logical step, if there was strength in this market, would be this bottom bound to the channel before another test of the bottom of the channel, we would have a test of the top of the channel, right? Which we never got. So the idea is that now we have continued weakness with a possible new channel being formed on the new trend line, okay? So what does this mean? Well, it means generally that you shouldn't put all your eggs in the bullish basket at the moment, because right now we're testing the bottom of this channel and we have this big gap to fill. Should we cross under the 212 mark? Should we make under this Darvas box or this channel, right? Which we've already tested under the 214 mark one time. We have the chance to create a new trend to go downward. Okay. So when you're asking what is the trend, you never want to trade against the trend, right? You want to always go with the flow, because the idea is that if you go with the flow, you go with the trading that is in front of you, you're not going to miss out. You're not going to lose out, right? You're going to eat because you're essentially in the direction that the market wants to take us, right? Now, the only thing that's going to change um, these ideas, this market, is going to be essentially a big change in the current view of geopolitics, in terms of what uh, is is the expectation from fundies, from institutions, from banks, to explain to us where they want to take the market. It's not about where we want to take the market, right? Um, we are generally little fish. Uh, I'm a little fish. I'm not controlling hundreds upon hundreds of millions of dollars, and that would make maneuvering really difficult. So that is the general idea of the trend, right? So next step is trying to decipher where we can make money on an options chain, in particular uh, the Apple trend, right? So for instance, let's draw a trend here, right? If we think Apple is going to continue to move down, right, and we think Apple has this move, right, into the 282 range to test the bottom or test this next trend, right, which we shall draw right now. So let's draw another trend here to draw where the tops and bottoms of this next area could possibly be, right? Um, so what we have here, we're going to draw this trend, and the concept here is that that's a trend line. I'm sorry. Let me adjust my drawing here. So we have this trend, right? So the idea is that we have this trend, and where does it really take us? Okay. It looks like right now we're even at the bottom, right? However, uh, one second. Sometimes I'm having an issue seeing something here. Okay, so here you have this trend, right? And you have this other box here, right? So you have this channel here. One second. Let me delete this. Kind of made a mistake here. Undo that channel. There. Okay, so you have this other area that we were kind of hovering in, which is the 186 range to 190 range, right? And if you look here, we were actually hovering in this area before as well. Let me pull up this is the 4-year one day, right? So as you can see here, we were actually hovering in this area for a while, right? So the idea is that we have this channel here being made from the bottom, I'm sorry, from the top of the previous channel that was here to the top of this channel, right? So we have this channel drawn here, okay? And this channel brings us to 194 to 186, 181 area, okay? So the middle of the channel brings us to 186, which is the previous Darvas box and the previous support, right? But as you can see here in the support script, we dropped to a new support at 212.55, and should that support not hold, there is nowhere to go here until we reach this previous channel here that we were at before, which is again at 194.92 to 180. Okay, so Knowing this, right, and knowing that we're in this channel right now, and we're having trouble holding this channel, how would I particularly play it, right? Well, they have ER coming up on Thursday, which means that contracts are going to be really, really inflated. And I don't know how many people at this particular second, in terms of social sentiment, in terms of what the market and CNBC is going to pump up tomorrow, I can't tell you for a fact what they're going to say, right? What they're going to do, whether they're going to pump Apple, whether they're going to try to dump Apple, whatever it is, right? But what I do know is that this channel, if it doesn't hold, and we come back down under this area where there's very, very little volume, where everything's very, very thin in terms of the market profile, right? I can see a move all the way down to the 186 range, all the way down to the 180 range, right? Uh, is it going to go down to 150? I don't know. I'm not going to bet that much, but I will want to take a bet for the move down. So knowing this, knowing that this is the trend that we see currently on Apple, right? We're going to take a look at what the options chain currently looks like on Apple. Now, of course, this option chain is not live, right? So since this option chain is not live, right? What we're going to be able to see is just um, previous close of action, previous open interest, and what the market thought of at the time of close, right? Now, generally, a put call ratio above zero point 0.7 is generally considered bearish, right? Um, that is consider what that is what it is. But that's really not enough. That really doesn't tell us much. What we need to know is really option time and sales, right? And we need to know what the last bets were. We need to know what big money wants to do. We need to know what they're thinking as well. So we have a thesis that Apple's going to move down, right? We're thinking that Apple's going to move down. So we're going to see if there is any corresponding bets to our thesis on Apple moving down, right? So currently, the first thing that we see here is Friday. The biggest buyers was this $2,000 contract move at $770 a piece, right? So $2,000, $770 a piece, with a delta of 49, right? While the underlying was 213, right? And then we saw the opposite play, kind of, where a big bet came in. I don't know if you can see that. Where a big bet came in, right? And let's. I'm gonna add a little source here so we can actually see this better. All right. So maybe that now you can see better. Okay. So here you have um, the day's biggest options, and we can see what the time and sales were. But we don't need to see all these one contract, two contract blocks. We don't care about those. What we need to do is we need to filter out the quantity that we have. So what we need to do is make sure that we have only bigger orders, right? So this is a 5 contract minimum. For some reason, I'm still showing um, very weird. Okay, so here is quantity. It's still showing me bigger orders for some reason, but here it is. Okay, so what we have here is we have a lot of calls being bought, right? And then we have some puts being bought. But it looks like there's a lot of calls. Why is this quantity not filtering out? Weird. Very weird. So for some reason, quantity not filling out, so I'll just go by biggest quantity, right? So here is the biggest quantity trades. And this is what we need to look through and understand. For instance, we have a buy right here, which means that someone bought the underlying equity, right, and wrote the calls on it when they bought the underlying equity, right, which means they wanted to sell premium on these 210 calls, okay, and and probably rake in the premium delta, and maybe they'll sell those calls and then hold on to the equity or whatever it is. But essentially, they were looking for to essentially make their equity cheaper or free by doing that. I mean, no one really buys equity then writes calls on it expecting a move up. The idea is that if you're buying equity and then you're writing calls, that's your insurance, right? If you thought that the if you thought it was going to move up, I mean, you would probably sell puts, right? So there's this giant buy right here, which is a kind of a bearish indicator, okay, and that puts us under 210, which means that they're looking to have insurance up to 210. Okay, they already sold this person has already sold their equity essentially at underlying of 215. They've already sold their equity essentially at 20 229. They essentially sold their equity at an underlying price of 229. Okay, already. Okay, so they don't really care if these calls go worthless on them because they wrote those calls. In fact, they want those calls to go worthless, so they essentially get $1,424 per call, which in which case they have 1,048 of those calls. Okay, right? And then you have all these big put buys, right? But this is a put spread, right? So we have to decipher what the other end of the spread is, right? So essentially, someone um, it looks like someone um, bought and sold at the mid. It looks like these. I cannot tell you what the other side of this spread is at the moment. We would have to look through and decipher, right? But a lot of the notional flow, a lot of the underlying flow, to me, looks overall bearish. Like more buy right. Look at this, another 210 buy right. In other words, someone probably saw that other order and then we're like, hey, that's a smart idea. I should do that too. Okay. So here's another one. Puts, right? Uh, literally, 770 puts bought at the ask. Puts that were bought at the ask, right? 443 of these things. Okay. Meanwhile, calls are all being dealt with and being sold at the mid or at the bid. Okay. But you look at the puts, and yeah, no, there's a couple here that are also like, yeah. So that's what I'm kind of pointing out here. So the flow is kind of telling us that when we look at the underlying here, when we look at the actual bets that are being made, Apple looks to be coming down. Okay, great, awesome. What does this mean for me? Well, nothing yet. What it means for you is that your thesis of Apple coming down, if you have the same thesis as me, is probably correct. And now you should actually look at your actual buying parameters, right? So here is the option chain for uh, uh, for uh, Apple. Okay. Now the option chain for Apple. Okay. If we're gonna go with what we think is gonna happen, right? If we're gonna say, okay, we're going back under 200. Okay. How do I capitalize on that? What does that mean for it to go back under 200? Okay. Well, in order for you to capitalize on that, right, you have to assume that the move you want is going to take place in how long, right? How long will it take for that move? Well, let's look at this chart, right? The move up on Apple, if this is all daily candles, right? This is 1 month's time, right? Okay. The move up on Apple took 1, 2, 3 months time. Okay. Moves down on Apple take half a month. Okay. So knowing this, knowing that a move up takes 3 months and a move down seems to take half a month, takes 15 days. Okay. We should take contracts roughly with at least, I would say, delta 3 to delta 4, meaning that you have a 30% chance of going in the money at the time that you bought it, right? So we want to go with, let's say, a delta 3, delta 4, right? But we want to have enough time, okay? Now, I don't know about you, I'm not buying weeklies. I would not buy November 2nd because, well, I cannot be sure whether the drop is going to happen this week. Yes, they have ER on Thursday, but Ivy is going to keep those contracts floating, and we can't say whether this ER is still bullish or bearish because, well, we have another couple of days. But with this thesis in mind, if I wanted to take a put on this, right, I can take a reasonably, other people are going to have the same bet, right? And so those particular contracts would go up reasonably, right? So if you want to take a weekly, which I do not recommend, right, you would go for, say, the Delta 3, which would be a moment, Delta 3, which would be the 210 put, November 2nd, 210 put. Surprise, surprise, that's a lot of, we saw calls being sold at that point, right? Which the person thinks that those calls, the 210 calls, might go worthless, right? Okay. Otherwise, the person has shares backing it up just in case he has to actually pay out those calls, and he will hold them till expiry because if he gets assigned, those shares essentially uh, are his backup, right? But if you're taking his bet and you think that those calls that he sold are going to go worthless, right? That means you think that Apple's going to go under 210, right? And then you have to make the decision of the contract you want, okay, based on your account size. Now, generally for me, I'm gonna go ahead and say I would totally love to take these 210 puts for this week because, well, Apple making a $6 move in a week is not really much. So as it gets closer to 210, if that is the opening move, that will probably pay out very nicely. However, I'm not going to go with that kind of trade. If I think Apple's going to break down, I don't think it's going to happen on that day. I think it's going to happen the week after, or even the week after that. So I would go with the monthly contract. I would go with the 16th of November, right? And that gives me a little bit more time. That also means that IV will build up a little bit less on those contracts. However, if the move happens that I'm looking for, I'm going to see a lot more profit on these contracts, and I'll be able to hold them for more profit should I choose to. If I want to go for a quick scalp and I think the move's happening right then and there, of course, 210 makes sense. Of course. But it's not something that I'm really necessarily looking for, right? I'm looking for to take advantage of a move down, and I don't want to have to worry about whether the move that I am looking for is happening. I would rather try to take a contract that is more fitting for me. And a contract that is more fitting for me is when I look at these November 16 contracts, if I think that there's going to be a big move down, I would be looking at the November 16 200 puts, right? Or even the 190 puts. Now, understand the 200 puts are delta 22, which gives them only a 22% chance of going in the money. The 2075s, which are delta 3, gives them a 33% chance of money, gives you a much better risk to reward, are currently sitting at 525 and 550, right? Bid and ask, okay? Now that is kind of a pricey bet, don't get me wrong, but when I look at the actual volume, when I look at how much has been actually traded on these particular contracts, and I look at what kind of contracts and volume were traded on, for instance, the call side, I don't see much heavy lifting being done. When I say heavy lifting, I mean guys who take big major contracts. You'll see it on the SPY all the time that are in the money, and they hold those to make a lot more money, right? Of course, because a $10 move on a contract that is worth $50, a $10 move on the underlying, that contract goes up to $53, $54. You know, $1,000 is not really anything to scoff at in the time frame of a day, especially when it comes to per contract. So what we look for is guys who are doing heavy lifting. And when I say heavy lifting, I want to see puts that are out of the money, okay? Or calls that, I'm sorry, puts that are in the money or calls that are in the money being bought like hotcakes. And you don't really see that. But meanwhile, we look at, for instance, the 240 puts, you got 22 of those moved. You look at the 235 puts, right? 65 of those were sold, okay? Right? So that leads me to believe that there is some sort of heavy lifting being done on the put side. Someone wants to drive the price of these down, okay? However, on the call side, all we have is 20 contracts at 36 contracts at the 145 and the 155 on the 150. And then on top of that, we have to take a look at those contracts, whether or not they have been sold at the bid or the ask. So how do we do that, right? So what I'm going to do here is I'm going to right click on this contract. You can't see it because of the stream, but basically you right click on the contract, right? And then you can send the contract to a chart. In this case, I'm going to send it to the red chart. So here is this contract, right? Now this is what we call the heavy lifting contract, right? Now as we can see here, there was a lot more movement on these contracts when they were, $21, okay? When they were $26. You can see all this movement here, all this volume here on those contracts, right? Which is great, which means that there was heavy lifting being done at those ranges, right? However, we start to see a big, tremendous spike in volume here when the contract pricing is around 50 bucks. In this case, actually $45, okay? So someone unloaded already at $45 on those contracts, right? Now these contracts have hit a high to date of $82, right? And are now starting to dwindle in value, okay? Which leads me to believe that these contracts might have actually been sold. So if these contracts are sold, that means the heavy lifting, the big money is starting to leave. And if they're starting to leave, well, Apple doesn't really have much money coming into it and doesn't have much support, right? Now, those contracts were sold at $65, right? When the underlying price was $215, right? I have to double check that right now. Let's take a look at Apple. Yeah, so those were 150s, right? Or no, well, those were 145s. Those contracts were 145s, sold at $65, meaning that they were sold at a general strike price where the underlying was, if I am not mistaken, $205. Is my math correct on that? 145, 65, 150. No, that's 210. They were sold at 210, essentially, where the underlying was $210. Okay, so if the underlying was $210, but the contracts were sold at where the underlying was $210, but we haven't met that, and $210 is where the resistance is, that leads me to believe that there's, more likelihood of downside. So now that we got that out of the way, and we understand that, we have to make our decision on what contracts we want to purchase to take them. Now, the concept is that if you think the move is going to happen, right, and you think we're going to go down to, say, even 180, right, that means a 190 contract will eventually be worth $10. Okay? That's what that means, right? So a 190 contract currently for November 16th is sitting at $2. So your maximum reward is 500% on that contract if the move you're looking for happens. If the move you're looking for does not happen, you're obviously not gonna make that 500%. It is very, very unlikely. It just won't happen. Um, you might make 100% of those contracts, $2 or $4. Sure, why not? Okay, but that's only if the trend falls in your favor. That's only if the trend lines and the channels that we draw fall in your favor. Now, like I said before, we have these other channels drawn here, right? And you can see very, very clearly that Apple has this move that it can make and fill this gap all the way down to 190, 186, right? We see it very clearly. The question again, when is it going to happen? Now, if we think it's going to go to 190 and we want to take these contracts in the money and we think it's going to happen in a 1 week, if we think it's going to happen in 1 week, why not buy time for 2 to 3 weeks, right? If you think it's going to happen within a month, why not buy time for 2, 3 months, right? If you think it's going to happen tomorrow, why not just buy, the week's contracts? You have to make that decision on your own, of course. I would say, of course, always buy time. Always pick the strike based on your move. So if you see a move to 180, right? Be reasonable, of course. Don't say this move to 180 is going to happen overnight. I mean, of course, it's AMD. We can say, shit happens, right? The AMD, that move, that shit happens really, really fast. Okay? And that's fine. Because if you're holding the correct contract, you've still made a ton of money. And more so than the contracts that expire tomorrow. Because chances are, most people were not smart enough to buy the 5 cent contract for 10 points out of the money to sell it for $10. It's just, I mean, it just doesn't happen. More likely than not, the person who actually saw the trade took a contract that they can take in the money very, very easily and rake delta. That way it's safe. I'm not saying that everyone does that. I'm just saying that that is more likely case scenario. Okay. So like you see this move coming down, you take 2 weeks out, 3 weeks out, a month out, 2 months out, whatever it is, and you look for the delta that makes sense in your case. So in AMD's case, right, this big move just happened. IV is going to be out of control, insane. All contracts, up or down, are now going to be probably 100% IV in terms of value, which means that all contracts, doesn't matter what it is, went up in value 100% on time value. However, it doesn't matter much because the Vega burn has destroyed contracts that moved out of the money. Okay. Now, a lot of people always ask me questions about Greeks. Delta, again, probability of going in the money, right? Understanding that in terms of what Theta and Vega do as well. In terms of Theta is essentially your time value, right? Vega is the rate of change, I believe, right? Vega is the rate of change that the time value has on your theta, I believe. And the concept there is essentially if you were to put your Delta went up like crazy because you went in the money. Um, you've gotten a lot of theta added to your contract because if you have bought time, you now have time value on your side, and your vega, which is the rate of change on time, um, or I believe that's gamma. Gamma's rate of change, and your well, yeah, and your rate of change on time has now gone in your favor because your contracts have gone in the money, right? So, in order to choose these kind of contracts, you have to see the move, you have to draw the trends out, right? You see the trend going down, right? You see the trend going down. So you say, okay, if this trend continues, right, we're gonna at this rate, we should be at around $19 by uh what is that? November 9, right? If you follow this straight line up or down, right? If you follow the straight line down, you should be at this rate at this time, right? So the idea is that options are already priced for that move. However, um, your job is to actually find the cheaper contract, the contract that people don't really see, or the contract that seems to be unusually priced, um, or a contract that people don't think is going to go in that direction. Okay, so in order to choose these contracts, again, you're looking at you're looking to say, okay, we're looking at AMD. You say there's a move down here at $28, right? There was a move down. You could have taken, say, a $20 contract, or not 20. You could say a $28. You could say a $24 contract, right? Those $24 contracts would have been. Let's take a look, right? November let's take a look at, for instance, the monthlies. November 16, okay? $24 contract, November 16. Let's add that to the chart, okay? And we could have taken those things at $1.40, like a dollar. Literally, you could have taken those things from $1.45 to a dollar, right? If you saw the move, okay? And they were worth at one point $3, right? But conceptually, right, even if you had bought them at $3 and you were sure of your move and you can follow this trend at AMD and you bought them at $3, okay, just as an example, okay, and you bought those $24 contracts at $3, okay, and you took those $24 contracts in the money to $20, right, you're essentially $1 above your premium. That's now a $4 contract, right? And then on this big move down, you've made the difference between $4 more, right? So now you could have sold your contracts at that big move down. I'm willing to bet at around $7 to $8, right? Let's take a look at that one more time. Yeah, you could have bought them. You could have sold them easily for a peak value of about $6.90, and they hovered at around 622. And these contracts, more likely than not, are going to continue to move up. Okay, because as they go more and more in the money, and they rake in more and more delta, um, they will just gain value. It's just the way it works, right? So that is the concept of which you're choosing these strikes, right? So if you chose that strike and you had that much time, right? While you would have experienced some temporary drawdown, if you were so sure of your move and you held through the move, that is where you actually make money on the contracts. You don't really make money on the contracts scalping them unless you see the move right then and there, in which case that happens a lot, right? Um, but you won't really make that much money um, scalping a quick contract, not to the level of where you would if you take, say, a dollar, $2, $3 contract near a top of a Darvis box breakdown and let it run all the way down to the bottom. It doesn't happen very often, but it is the way it is. Uh, yeah, yeah. So as I said, in terms of searching. So delta, again, probability of it going in the money, 33, delta 33 is the delta of which it goes in the money, but it's also in which it the rate in which it gains value or loses value. So that's something to understand as well. For instance, a delta 99 contract um, gains value and loses value at the same rate as the underlying. Okay, so in other words, a delta 99 value, if the contract is say $99 or let's say $50, and the underlying moves up a dollar, then the underlying contract then the contract moves up a dollar with it for a delta 99. A delta 3 will move at, of course, a third of the speed, but if you get that move, it will accelerate quite nicely. Um, Theta is your rate of decay. Theta is important to watch theta because you don't want a contract um, with too high of theta. Um, let me just make sure I get this completely correct here because it is Sunday and it's been a long day. So yeah, I don't have theta listed here on the list here for let me get that. Yeah, I don't have theta listed here for some reason on the contracts here in TOS. I generally trade with IB. So I have a bit of a different thing, but yeah, the general idea is that um, choosing the strikes is very, very important because I see a lot of people all the time picking strikes that essentially are meant to go worthless. I see all the time people taking, for instance, Tesla, right? While Tesla does have a penchant to move, 30, 40, 50 points in a day, yeah. So while Tesla has the ability to move 30, 40 points in a day, and I I see all the time people taking contracts like right now Tesla would be underlying, for instance, 310. I see all the time people taking contracts for 350 at the end of the week or 250 at the end of the week, expecting that huge move up or down. Okay, and it's just not right. Generally, market makers put those contracts out there uh, because they are meant to fail. Like I look here at the option chain, and we have a for 16th of November. You want to take a Delta 10 255 put, and those are currently sitting with crazy spread, uh, where the 250s are going for $2.50 for a Delta uh, 0.08, right? That's a contract that's obviously meant to fail, that is meant to lose its value because the delta is so low. And I'm willing to bet the theta is so high and the theta will burn it out because as Tesla decides to move the opposite direction, the vega will completely drain of its premium. So yeah, and then like, what is this trend on Tesla? If I was to draw this trend, what am I drawing here? For instance, let's just draw this channel here. Top of, say, 389, right? We have a top of 389 for that from that famous 420 funding secured tweet, right? Literally, Tesla's in a channel in which the bottom is 242 and the top is 390. And that is why you have option priced like this. That's why you have options that are $50 to $60, $70 out of the money that cost $500 to buy because you have Tesla making crazy moves like this. But I want to point something out here, okay? The overall trend here on Tesla was to the downside for a while, right? So the overall trend on Tesla was to the downside for a while until, you have more Elon tweets, which brings it back up to the top of the trend. And I believe that was the shenanigans of ER, right? Yeah, that's shenanigans of ER here. And then we brought it back down to the trend, right? Then we have infamous Tesla uh, tweets, and then we fell back to the bottom of the trend, and then we have infamous Elon Musk doctors ER, right? So, yeah. So now the question is, we bouncing at this linear regression channel here, and the question is, are we going to go back up to 387? Or are we going to go back up, down to 342 on a rejection of this linear trend? Last time we broke over the linear trend, we made it way high up there, but only time will tell. We currently have completed a chopped cheese here, one of the setups that we use in the channel. So we'll see what Tesla does. But how do you play this Tesla, right? Because all contracts are crazy expensive, and you have delta, uh, an implied volatility of 100% on the weeklies, and on the monthly 77%. I mean, we have implied volatility that is essentially crazy in August of 2019, but not so much in January. I mean, it is what it is. You can't really judge a Tesla by its chart, right? Because the chart will just flip on you at any second with Tesla. So let's take a look at CMG. Okay, now this is one I've been wanting to look at for a bit now. Now this is the general trend of CMG over the course of 4 years on the daily chart. Now I'm going to draw a really, really long-term trend here. Really long-term trend channel. So the concept here, what I'm drawing here, is essentially a trend here that I see, because we have a ginormous, what looks to be an inverse head and shoulders here, and a rejected head and shoulders that was formed here, right? That turned into an inverse head and shoulders and a cupped handle on the longer time frame. Okay, so that's what we have here. So I'm going to draw this little channel here. Okay, and we're going to try to see what we can decide on trading on this channel. So I'm going to use the channel tool to draw this channel from the bottom here. We'll say this support here. I like this support. So we're going to draw this channel here, bring it to the top here, to this resistance. Okay, so essentially, if I were to trade CMG here, okay, knowing that they just had earnings and they actually turned a profit, which means that people are still hungry eating tacos, okay, and CMG has formed this giant thing here, okay, and conceptually, if CMG does not break down through this channel, CMG has a move going all the way back up to the trend line, which is at 497. Now, this is quite a Hail Mary of a move. We're talking about an 80-point move, okay? So an 80-point move is quite a bit, right? So how do we play CMG? Okay, so we're going to take a look at the option chain again. Okay, we see that the IV is not really outrageous on CMG. In fact, the IV has only been the IV has been below 75% of the time this past 3 months, right? So that would mean that that essentially IV is really high on these points to the point where 30 to the point where if we got these contracts in the past 3 months, the leaps, they would have about 75% more time value inside of them. But that is fine because a ton of value has been drained from the calls already, right? And time value for the puts, while drained, the put has gained uh, actual value from the underlying. Okay, so what this means is that essentially at this point, calls are 75% off, while puts are trading at 75% premium from the past 3 months. Okay, so knowing this, okay, calls are down 75% on average. We're going to look to see if anyone's doing any heavy lifting or heavy putting. Okay, so here I'm looking, we have actually quite a few people doing some heavy lifting on November 16th. I see quite some at the money calls, right? Not so many at the money puts. I see so many. I see a couple of at the money calls, and we see some in the money calls. Not too many though. Okay, which is not necessarily a bullish sign, right? It's not. It's not a bullish sign. It's actually kind of a bearish sign. However, we also see some volume that came in on the out of the money calls. Okay, for instance, we see here 470s, 134 traded at $3, and those are at delta 21. Okay, they have a 21% chance, essentially, of going in the money. Now uh, that is kind of low probability, right? But it seems to be what people are betting on currently. Okay, and we have some noticeable volume at 450 call strike, 154 calls bought at 950 to 970. It looks like. Let's take a look at the underlying option assignment sales, and let's take a look at what we have here. All right, so here we have the option assignment sales, and we filtered out all the small orders, and now we see only the big orders, right? Now, part of the big orders here, we see a lot of calls actually. We see some put buying here. We see 400 puts sold at the mid. We see more 400 puts sold at the mid. More 400 puts sold at the mid. About 600 400 puts sold at the mid. We see some 420 puts sold at the mid. But here's where things get interesting. We have here what looks to be a late May spread. We have December 400 puts, but we have March 500 calls. The March 500 calls sitting at $15. Those March 500 calls sitting at $15, those could be a big pair. I'm thinking, like if CMG makes the moves that it usually makes within, I don't know, 2 weeks, and it goes back to 500, by December, those March 500 calls are going to go for $100 probably at $15 traded, right? And those are Delta 31s with 31% IV. And those were bought while the underlying was 438. So those were actually bought at higher than the close. Let's see what else we have here. We have 455 puts, mid. We have calls, 440 calls. November, 440 calls, $15, 37 of them. Okay. And okay, now we have, this is a spread here. The 432 calls and the 455 puts. Someone looks like they sold the spread at the mid. So we have to look at this based on what we have here, right? So we see that there's a lot of calls being actually bought at the ask, and that's a really, really bullish sign. So knowing this, we're going to take a look at the option chain. We're going to say we want to follow the call idea. We want to say that perhaps CMG is not going to make uh, is we're going to say that perhaps CMG is not going to go back down into its previous channel of 345, 304, 200, where it was uh, in the previous year. We're gonna make the assumption that in fact CMG might want to go back to 500, and who knows, maybe even go back to its former glory and back up to 750. I don't know when, but it's possible. So we're gonna say, okay, so CMG, if it doesn't reject, I mean, if it doesn't fall through this this trend line that we have here, it doesn't fall through the 415 area, and it actually bounces and stays above the 415 area, and it wants to go higher, okay, and it wants to go back up to the top of the trend, which is the top of the channel, which is going to be 524, okay, just in case. We would want to trade 450 calls, 460 calls, 470 calls for the next 2 months, next 3 months. And we would have to try to decide what best fits our profile, okay? And that means picking out, for instance, not November 16, but perhaps December calls, and perhaps taking December 570 calls, which would be, I'm sorry, not 570, 470 calls, which would be around $10, right? So we would have to wait and see how that rejects and where that chart forms. So if it breaks under, we would take puts. Sky's the limit. I mean, you could see here, puts generally going for cheap, right? If you think it's going to go back into this channel, this previous channel where we had this giant spike up at, what is that, 335? I mean, the 355 puts are cheap. 355 puts for December are sitting at 265 and 350 at the high, right? So we would be waiting to see if we actually break through this support here, which was made, right, and this channel that was made. So first point of breaking through will be the 430 mark. After it breaks under 430, the next point that we have to break under would be around 411. And after 411, sky's the limit, right? So you would want to try to take those kind of puts 2 months away based on this idea, because you don't know if this particular move in this area is going to happen overnight. You just don't. But what you can do is position yourself so if the move does happen and you speculated on it correctly, you will make a nice profit on it. So let's talk about what this nice profit would be, right? Because the idea is that you're going to be holding through some drawdown if you believe in this kind of trade. If you believe in this kind of trade, the drawdown you'd be holding through might be a couple dollars, right? These contracts from say $3 might go back to $2 or 150 even before they go back up. So this is why I say you have to position yourself correctly for these kind of trades, and you cannot go really like you can't really put all of your funding into a trade like this because it is purely speculative. You're looking for a breakdown and you're looking to fill a gap, and this will happen really fast if it does happen, right? Right now, I see this possible move that says yes, we could break down, but I see flow. I see option buyers saying that no, we have a possibility of trading in this channel a bit longer and maybe going to 450. So both sides of the trade, right? If you see the move down, you want to see this possible retest of this channel here, okay, you would obviously you would take 350 puts, 355 puts. You would take some out of the money puts at least 1 to 2 months out, right? And you would wait for the move to happen, right? Or if the trend continues in this direction, those particular puts will just continue to gain value slowly. If you think that essentially this is the top, right? You would take at the money puts and they would never lose value. But it's not a perfect world, and they're not linear. There's still theta decay involved, and things go down. So you want to limit your risk and your exposure. Um, so I hope that that explains how to pick certain strikes out and how to pick certain dates uh, for your contracts. Just a quick again. If you expect the move to happen in a week or two, take a month out, take 2 months out. If you're expecting a 100-point move, uh, don't unless it's Amazon or Google or an Indus, and don't expect to have for that move to happen when you buy the contract. So this is why you should buy time. I hope that some of these techniques have been helpful. I will be sharing the script for the support and resistance within the channel. And again, when you want to take these contracts, is essentially, sorry, can you move the TOS? All right. Yeah, so essentially, what you want for these contracts is essentially to make that move down. So you would take the puts. Sorry, I got thrown off there. I was reading something. So you would take the puts, right? And you would wait for the move down to happen. And as the move down happens, and as the trend continues in your favor, and more people see that possibility, your contracts should continue to go higher, right? And if you think that we're at the bottom of this channel here, and we're ready to go back up to the top of this channel here, and you can totally trade that because as you see here, we have this channel here that was formed from 2017, the summer of 2017, where it moved down. However, I also want to state that this could be just a cyclical thing, right? Where we've already formed this cup and handle, but we could easily come back down because the linear trend regression over the past 4 years has shown us this move down. So knowing this, the trade could go either way, right? You take the 350s down and trade it all the way into this channel of 280, 240, and possibly make $50, $60 per contract. Or you could take the upside trade, which would be, the 450, 460, 470 calls for the top of the channel test, which would bring you to 499-ish. And that is just a quick primer on how to trade um, the channels and the possible breakdown of channels um, for in the options world. In terms of the options chain, which strikes to buy. I like Delta 3s personally. That's just what I like because those generally get the best risk to reward. Um, I generally like to sell Delta 7 and buy Delta 3 if I see a move which can turn around. If I see one of these big turnaround moves, that way all the Delta gets burned out of it and make some money. However, strategies vary. It depends on the charts, and right now we are in really really odd territory. Before I go, one thing I wanna stress is that this ER season, this ER story, um, it seems like really to me is only providing downside protection at the moment before more possible massive downside. Generally, what you see in ER season is companies like to move at the beat of their own drum, so to speak. They like to move on their own, and that can be seen very easily with like Twitter, which beat ER, did great, but gapped up. However, is having trouble now creating an actual new channel. It's still sitting in the same channel that was created, um, over the past 3 months. So you have this situation right now where the ER season story is not really being effective in the market, and it's not really holding up. The ER season is, for the most part, a dud as of right now, and all eyes on this week are on Facebook and Apple to perform. And essentially, if they don't perform, um, there is more likely to be a move down, similarly to how we saw with Amazon. Um, so that is just something that we have to look at and look forward to for this week, Facebook and Apple. And if they do not perform, if they do not report great guidance, great earnings, we're just going to see more downside in the market. Um, Possible Feb low test. We've already seen the 2680 one time, but I think that there's going to be a real February low test. We've never really tested the February low on ES futures that happened after the Trump tariff tweet, which was I believe 2500. And I want to show you guys a little chart here before I go. This is the SPY, okay, and we're gonna zoom out here, okay. Now is um, this is the SPY, right? Now everyone was talking about the Ray Dalio anagram analog, right? And I just need to show this to you guys so you guys understand, right? Leo, 1 second. Trying to see if I can find it. Uh, 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 uh. In Yeah, I'm trying to find this Ray Dalio chart. Not so simple. It's called the Ray Dalio analog. Dalio analog, I believe. Yeah, here it is. Dalio analog, right? Now, everyone was touting this thing at the beginning of the year, right? When February hit, everyone was touting it, and everyone was touting it again in March. Um, but that ain't shit. Now I want to show you guys what I see here, right? So this is the anagram. Move this right here. So this is the anagram, okay? And this is kind of what I'm seeing, okay? So um, as you can see here, right, we have this move up, right? This is, first peak, and then shit just kind of came down, and then here's the second peak, right? And then we really made that move down, okay? Now that's awesome, right? Now let's take a look at this chart. Oh boy, doesn't that look eerily similar now? Huh. Huh. Let me just take a look at something else. And what is it? The stages of the market. That's the other image, right? The stages of the market. Here it is. This is the other one, okay? Here's the stages of the market cycle. This is another one that's kind of important to understand, Okay, let me take the screenshot here for you guys, and this will be my final send off. Okay, so now that we see this big thing on the SPY, right? Here's the stages of the market, right? Now, I think that January was this right here. Okay, and right now we all thought we returned to normal for the past month. Okay, but the reality is we're about to go there. That's just what I see, and who knows whether it's going to be true or not. But this is where I really listen. I never thought in a million years I would be that guy standing on the corner of the street uh, talking about how the end of the world is coming and how everything's going to go to shit. I didn't think I'd be that guy holding up that sign, you know, in my slippers and a broken quarter and broken down, jackets and shit. But this is just what I kind of see right now. I never thought I'd be that guy, so I'm just throwing it out there. Anyway, have a great evening, guys. I hope you learned something today. I hope this workshop helped out someone, and I will see you all tomorrow when the market decides if we're going to return to fear. Good luck, guys, and have a great evening.